Hey, welcome back, traders. It's John. It's time for a general market update. It's about 3:40 on Friday, January 19th, 2024. I just got back to Boston from my West Coast trip. I was out there with my son. We were visiting some graduate schools that he's thinking about attending. We hit U San Diego, UCal Irvine, UCal Santa Barbara, and even UCLA. So quite a trip. It was a great week. But the market also had quite a week. We had some shaking of the tree on Wednesday and some strength following through today. So a lot to talk about. So let's dive right in. So the presentation again is by Rain King LLC, and I am an amateur individual growth stock investor, and I'm not affiliated with MarketSmith or IBD. So the agenda is we're going to talk about the indices a bit, some breadth. Going to talk a little bit about market data and bear market rebounds. Then we'll get into group rotations, certainly a lot going on here, cross currents in January. And then we'll touch base on the action of the leaders and then our summary. So let's dig into the indices and look at some of the breadth. So this is the NASDAQ composite as of 1:30 today when I cut the chart. Couple things that are worth noting. First of all, I wanted to look at, the index had a pullback. Then we made this attempt to get to new highs. We pulled back again, and we had that really sharp, I'm calling it shaking of the tree day on Wednesday, where things really gapped down. Things got a little scary for positions. But then the leaders actually came back strong. And then we've had the last 2 days, we've had two gap ups, and we're back to new highs. So what's interesting is under the hood, when you hit new highs back in here in late, December, we had new highs on the NASDAQ of about 200. As you'll see here, these large green bars, which are around the 200 area. Now, a little bit of a caution sign is we are now attempting to get back to new highs, and you can see that the new highs are only in the 50 range by this gray line. So that's a little bit of a caution sign. We want to see the new highs continue to rebound and expand to show us that this leg here that this rally is going to continue. So the good news is we're still in a healthy position on the index. The power trend is still on. And even when we look at a 5% pullback from the current levels, that would actually bring us down to the red line here, which is the 50-day moving average. And what's important to note about the position of the 50-day moving average, and what I like about the 50-day is it's actually, if you look at the breakout from this long consolidation, particularly this little area of support back in here before we really started to rally again, the 50-day is actually moved above that level of breakout. I like that because even if we come down and touch the 50-day with a 5% pullback, be all very, very, very normal action. So the only caution sign has me is looking at the net new highs and the just raw new highs, which right now I really want to see them expand again to give me more confidence. So a little caution sign there. Now, the small cap proxy, the ARK Innovation Fund on the left, we had this really, really strong run, 62% run up, and it's come down almost consistently down almost every day. It's about, a 17% pullback, almost straight down. It's actually undercut the 50, which is a little bit concerning. But when you put this into context of the big run up, hopefully the ARK turns around and gets some stabilization. Now on the right side, I'm showing the IWM. Again, strong run up, 27%. What's good about the IWM is its pullback came right down about 9% to touch the 50, and we've started to build some support off the 50. So that's a little bit more encouraging. Now, the IWM has a number of financial stocks in it, so maybe that's helping it a little bit more than the raw growth funds, which are more biotech and some other things that are inside of the tech innovation ARK fund. So we'll have to keep our eye on these as we watch the headline indice being the NASDAQ. But under the surface, we want to see these stabilize and turn back up. So let's move to bear market rebounds. So again, this is a NASDAQ chart. Now, this is a weekly chart. And what I'm trying to show is is really market data that I've been maintaining over the years. This is actually a data block showing after we've had a bear market. And you can see when the bear market, this is the decline of those bear markets. And typically what happens is there's a first leg up, then there's a pullback, a dip, and then we have the second leg up in that new bull market. So this gives us a little bit of context. So you can see here that we had a 38% decline, which I'm showing here on the chart. Here's the 38% decline in the NASDAQ. And we had a 44% first leg up. And then from the summer, mid-July, all the way down into October, we had this 13% decline. So that was our first pullback, about 13%. Now you can look historically at these numbers, which include a blend of the Dow, because some of them are quite old, and the NASDAQ in more recent times. You can see that the first leg average is about 73% up, usually has an average of about a 20% dip. And then you can see the column I'm interested in looking at today is the second leg up, which shows about a 39% second leg up, and then the second dip. Now, what I think is important is I took a look at this and said, well, if I just take the NASDAQ, which really is taking the data from the 2000s, which I think is fair, and we've had, this would be our fifth bear market in the 2000s. And when you look at that second leg and we take the average of the four, that's actually about a 29% second leg up. Which might be a little bit more representative because back in 1929, there was a huge leg up, which is distorting the averages. So if we used the average, which is 29% leg up, what would that put us at? So I've drawn that from this low right here. And if we look at a 29% potential second leg up, that brings us up into the 16,181 area, which is actually right around the old all-time highs for the NASDAQ at 16,212 and change. So it just gives us a little bit of context that, we might have some more room to run before we actually either consolidate around the old highs, or maybe we have a pullback. And again, we have some context of what the pullback might be if this is kind of consistent with the data. But I thought this data table was interesting to share with you, just to give us some context of what we might expect, some targets. So group rotations, there's been a lot going on in January. So let's get into looking at some of this. So looking at some of the leading groups. So this is just looking at over the past year. And I've shown the baseline really is the NASDAQ, which is shown in black right here. And then I've used all these industry groups from the MarketSmith database. And you can see that the ones above the NASDAQ showing outperformance are computer hardware, computer software education, computer security. And you can see even from the July peak where I've drawn this line, these have been some of the outperforming groups. There are others, but these are some of the major computer ones. Now, if we start to break this down a little bit, and we look at it from the follow-through day, which is right around here in early November, look at the performance of these particular groups. You can see since that follow-through day, the NASDAQ is up about 10%, but look at these other groups. Computer tech services up 21%, networking 16%, apparel shoe up almost 33% since mid-October. So some really good outperformance by these various groups. So when we're looking at groups, we're kind of drilling down into the market to find the leadership. So I'm going to take you through a couple of detailed charts as we break it down to say, let's look at the groups and see where the leaders are. So if we take this computer tech services group, first of all, its group rank is number 13, which is a very good ranking. And then I just looked at a number of the stocks within that group. GitLab, which is shown here, is one of those stocks that's actually performing quite well. You can see Globe and Ramp are also performing, and a company called GigaCloud Tech, GCT. I don't know much about this one, but it's clearly been a strong performer, and I plan to take a closer look at it, along with GitLab being the leaders in the space. So this helps you find, the strong group, the strong outperformance, and then you get into the actual names. Computer security group. Group rank number 3. This has been strong for the past 3 months, and clearly the leadership is jumping out at us. Crowd, Zscaler, and Palo Alto Networks are the clear leaders within this group. There's a lot of money pouring into cybersecurity, and you can see Qualsys, which is at the bottom here in green, it's been moving up recently, but it's lagging. This is not the stock you want to own in this particular group. It's not even outperforming the index group itself. So Qualsys is lagging. You want to be in one of the three, preferably in the top one or two in the field. So those are the strongest stocks in that area. Apparel and shoes has a group rank of 24, another strong ranking. Some of the outperformers in the group include Skechers. You can see Skechers is up over 30%. Deckers has been very, very strong, particularly if you notice, here's January. So even in January, Deckers has moved up. Skechers has flattened out a bit. Birkenstock, which is an IPO that came out in the fall, has also started to work as a new issue. So let's go into the action of the leading stocks. I showed this slide last week where I said, there's a lot of stocks here that are leading the market, but the true market leaders start to stick out even from the group of leaders. So we talked about Crowd and Now and others that were acting really, really strong. And there are some this week when we had the Shake the Tree Day on Wednesday that have shown us that they are actually really even strong as well. We saw Armed is acting very well the past 2 days. Elastic is starting to act well. So let's look at this closer. So this is the leading names versus the NASDAQ. And I've shown this from January 1st. So if January 1st, this line is representing 0 gains to date, you can see that the NASDAQ index is relatively flat for the year. It's barely green. But look at the real leaders of the market. Even after the Shake the Tree Day, which was a little scary on Wednesday, the real leaders have resumed their good price action, and they've actually moved to new highs. We got NVIDIA, Palo Alto, Nutanix has been very strong, AMD is showing extreme strength, CrowdStrike is strong, and even Elastic and Datadog have shown they're at new highs. So again, these are the really elite, some of the elite names. There are others, but I just wanted to make the point. This is how you can use some of these tools to try and find, to make sure that you're really finding the number 1 or number 2 leader in a field. So this next rally is really important to watch closely. I mean, we went from, late December and everybody felt that everybody's fear of missing out. And now we've gone to fear. There were some real drop-offs in people getting knocked out of positions on that Wednesday. And if you had your cost basis too high or you were chasing stocks, you probably had to sell things and got a little fearful on Wednesday. I had a position in Spotify. Stock came way down, hit my stop, ticked me off, and moved back higher. Everybody has these types of trades sometimes. They happen, they're common. You just, reevaluate and recenter yourself to take the next trade or to build your current positions. So quite a range of emotion, from fear of missing out actually to fear. And we've come back here on Friday with some really strong action. So it's been a roller coaster of a week, I think, in terms of emotions with the market. So on this next rally, as I mentioned, if your average cost was good, you had really good cushion going into Wednesday, but that dip was probably an opportunity to add to your names. Some of the names came down to their 20-day moving average, which gave an opportunity to add. Some came down to their 50 days with an opportunity to add, but you had to be nimble to capture that. If you didn't add, that's okay. Be patient. There'll be other opportunities. Now, again, I keep emphasizing I want to watch this next rally because I think it's very important. I think there's 2 scenarios that we could have watching this rally. A bullish sign, a real positive sign, is we see the rally get to new highs, which we are seeing today in the NASDAQ. And these leaders are participating, and they're getting to new highs as well. And we are seeing that with AMD and Nutanix and some others. But the third leg to the stool is I want to see a return to net new highs. This has dipped to some net new lows the past 2 days. So again, it's not a red warning sign. It's certainly a yellow caution sign. As I mentioned, we want to see this improve. So I want to see this, look at this closely over the next few days to see if this rally is going to regain some momentum. But it would be bullish if it did. Now, on the bearish side of the house, if this rally were to peter out and start to reverse hard with volume, that would be a very, very negative sign, and I would get much more defensive. And it would probably be decision time for you on a number of your positions. I know it would be for me. Positions that have less than a 5% gain, I might be looking to bank those quickly because I want to protect the stocks that I have bigger cushions. So if I have a bigger cushion in a stock that I'm trying to hold as a position trade, I might take some small gains, give me some gains, and that way I can hold through a deeper pullback to see how this plays out. But if the rally peters out with volume, I would get probably much more defensive, especially with positions that had 0 to 5% gains. I don't want those to turn into losses if I don't have to. So let's wrap up and summarize. Again, where are we? We're back at new highs. The breadth is showing, as I mentioned again, signing a little bit of wear as a caution sign with the net new highs. Now, the leaders are resuming their uptrends. Many of them have hit new highs. That's very, very positive. The indices are above the 20-day moving average, so that's evidence of an uptrend still in place, and the power trend is still in place. So we don't want to discount that until it actually shows us that there's weakness. Again, the caution sign that I'm seeing is that should say want to see improvement here. Again, that's my probably biggest concern with the market right now, but it's not. We still want to go with overwhelming evidence, which is still very, very bullish in my mind. So the leading stocks are acting well. We're seeing the most strong true market leaders are actually separating themselves from the average leader. And again, the Shake the Tree Day gave us an X-ray into the market to see who those really strong leaders were, and hopefully you have positions in them. Exposure levels, I think, still I would hold them in the 70 to 90% range. And the reason I hold them there is because of the net new highs. That caution sign is enough for me to not get any more aggressive than I currently am. And it also allows me some powder in my account if I can buy on a pullback that looks constructive on the pullback. So to wrap up, the quote of the week is this, and it's by J. Wells Wilder. He's the creator of the Relative Strength Index, RSI. So letting your emotions override your plan or your system is the biggest cause of failure. And I think this is really relevant this week when we had that Shake the Tree Day. You don't want your emotions to override your plan. You should have a plan in place that provides defense with your stops set. And you should also be looking at your potential drawdowns if the market situation gets worse and how much open risk you have in your portfolio. You don't want to get caught up and get all scared like on Wednesday and start to abandon your stops and just start selling, or not follow your plan and have stocks move through your stops and you don't take action. So stay with the plan, stay with your methodology. We still have an uptrend in place. And if you follow your plan and watch your risk, that's always the way to go. So that's the wrap up. It's the general market update for January 19th, 2024. Look forward to seeing you all on the next one and have a great weekend.